All right, everybody. Everybody's kind of sitting down, grab some food. I'm going to go ahead and intro the class, and then I'll hand things over to Erica here pretty quickly so we can get through the material. I see a lot of familiar faces. You were here yesterday, so I'll be pretty brief. So I'm Tyler Parks, the Director of Government Relations here at the Tax Foundation. The Tax Foundation is a nonprofit that studies tax policy at the state, federal, and global levels. We also have our in-house tax model that we use to model the distribution, revenue changes, and economic impacts of federal tax policy. Erica and Garrett, who presented yesterday, lead that team. So if you have any questions about the model itself, please reserve this for Erica. So the Tax Foundation believes that the tax code should be stable, simple, transparent, and neutral. And so today we're going to be talking about business tax policy, and you're going to hear a lot of these themes throughout Erica's presentation. So I'll explain a little bit about business taxation, but I'll leave most of it for later. So I think important thing to know, there are three important things to know about business taxation. Business taxes, at the end of the day, are paid by somebody, whether that's workers, whether it's shareholders, or whether it's consumers. There's a lot of academic debate over that, but the fact remains, people eventually pay business taxes. And then second, we know that business taxation is the most impactful on growth, whether that be pro-growth or hindering growth. The OECD and academics have found that the corporate tax is actually the most harmful tax to growth. And as I was talking about earlier, who pays is subject of debate, and Erica is going to go through where those points of debate are. And then third, temporary tax policy does nothing for permanent long-term growth. We found this during the TCJA, where the permanent corporate tax cut did induce growth, but the temporary provisions did not induce temporary growth, or did not induce growth. So those are three important things to know throughout this presentation. Erica will dive more into that. There are some business provisions that have expired or will be expiring on the business side. The two that have expired or in the process of expiring are bonus depreciation, or immediate depreciation for short-lived assets, and we have switched to R&D amortization versus R&D expensing, and we'll explain more later. And then in 2025, at the end of this year, the Section 199A pass-through deduction will completely expire. So with all that set in the backdrop, I'm going to introduce Erica York, who is our VP of Federal Tax Policy and also an adjunct professor at Sterling College in Kansas, where she resides. Erica works on the modeling at the Tax Foundation, as well as a lot of tariff research, and then also federal tax policy writ general. So with that, Erica.
Hey everyone, it's good to be here with you today, and thanks for taking some time out of recess week to study tax policy with us. Today we're talking about the business tax code. We're going to go over the basics of the corporate income tax and non-corporate income tax, look at how business taxes impact investment and workers, answer the question, do corporations pay zero in federal taxes, and then look forward at what's happening with some of those expiring provisions that Tyler just mentioned and options for reform. But before we dive into that, I want to do just like a little exercise to show why tax policy is important. How many of you, when you're walking down the sidewalk and you see a penny, will stop and pick it up? By show of hands. No one. Okay, if it's a $5 bill, will you stop and pick it up? If it's a clean $100 bill, will you pick it up? Okay, and you got to my next point. Now, what if the penny is stuck in like some gum? Is anyone going to pick it up? No. All right. If the $100 bill is stuck in some gum, would you pick it up? Okay, a few nodding heads. All right, you guys just engaged in economic analysis. You weighed the cost and the benefit of doing something, and you decided how you were going to respond. And when the incentives changed, you may have changed your behavior. Clean $100 bill, sure, I'll take it. If it's stuck in gum, maybe I won't. The costs and benefits have changed. When we do tax policy analysis, we're looking at similar questions and looking at how people respond to changes in the incentives that they face through the tax code. And when we're looking at business taxes, the question we want to ask primarily is what's going to happen to investment, to capital investment. So that's what we'll keep in mind. Before we dive into that, though, let's go over those principles of sound tax policy that Tyler mentioned. At Tax Foundation, we analyze tax policy with our macroeconomic model that looks at those incentive effects and how that changes the economy. We also do qualitative analysis. Is a tax policy proposal going to enhance the simplicity of the tax code? Is it easy for taxpayers to understand this policy? Is it easy for the government to administer this policy? We also look at neutrality. Does the tax encourage or discourage certain types of behavior, or does it stay neutral with respect to people's decision making and let them make the best decision for themselves, whether that's a business investment, whether that's a person deciding to work, to buy some particular product? Is it transparent? Is it really clear and easy to see when and how much taxes I have to pay, a business owner has to pay? Or is it hidden in a really complex structure? And finally, is it stable? Does it allow taxpayers to plan over a long horizon, or is it changing from year to year? And from the government's perspective, is it a steady source of revenue, or is it really volatile, which makes it difficult to budget, to know how much revenue to expect? So when a tax policy proposal comes across your desk, your boss's desk, your boss has a tax policy idea, you don't just want to ask, is it pro-growth? You also want to ask, how does it line up with these principles? Will it improve the structure of the tax code, or does it just layer on top of the complexity that we already have? And with that, we can get into the business tax base. And you might ask, why aren't we starting with the rate? Everyone always talks about the rate. The rate matters because you have to pay the rate on some measure of income. So we want to know what that measure of income is. When we're talking about business taxes, it's a tax on business profits. Profits are generally defined as revenue minus the cost of earning that revenue. So if you pay your workers a salary or an employment benefit, if you pay rent, if you pay utilities, if you purchase goods to sell and to use, those are generally deducted in the same year that you pay for the expense. But that's different when it comes to capital investment. Capital investment has to be depreciated over time. So you could imagine a farmer in your boss's district or a business owner, let's say a construction firm, they're deciding to purchase, let's say for the farmer, a new piece of equipment, maybe the same for the construction firm, maybe they're purchasing an excavator, maybe the farmer is putting up a greenhouse. They spend the money that year to make that purchase, to build that building, but they don't deduct that full cost that they spent. They have to take depreciation deductions over time. So what you'll see on the slide here is a hypothetical $10,000 investment, and let's say that that's deducted over 10 years. In real terms, because inflation and the time value of money reduce the value of a dollar going forward, the business doesn't get to fully deduct that cost. About 20% of the real value of that is erased over time. That means they don't get to deduct the real value of the expense that they had, and we essentially place a tax on that investment because we're overstating the business's real income. This discourages businesses from making investments. If you look at any type of business finance textbook, they'll tell you, look at the depreciation deductions, look at the inflation rate, look at your discount rate, see how valuable this is for you. If it doesn't meet a required rate of return, you don't make the investment. So when we have a tax code that stretches depreciation deductions out over time, that discourages business investment in the economy. And we have a lower level of capital stock, whether that's structures, factories, warehouses, machinery, equipment, software, anything that gets depreciated, we have less of it than we would if the tax system was neutral towards that decision. We also have deductions for net operating losses. So these are important because they ensure the tax system taxes businesses on their average profitability and doesn't penalize businesses that have really uneven earning patterns. So you can imagine a business has a $50 loss in one year and then has a $100 profit in the next year. Without an NOL provision, there would be no tax in year one, and there would be tax on the entire $100 in year two. With an NOL provision, you would carry forward that loss from year one, deduct it against your $100 gain in year two, and pay taxes on $50, which is your real profit if you look at it over that 2-year horizon. So NOLs are important to ensure that we're not penalizing businesses based on their earning pattern. And then we also have interest deductions, or deductions for interest paid. The tax code has historically had a bias towards debt financing over equity financing because the tax code has historically permitted virtually unlimited deductions of interest payments. And that was prior to the Tax Cuts and Jobs Act. But the TCJA introduced a limitation to 30% of a measure of adjusted taxable income that was defined in a manner similar to EBITDA, which is an accounting concept, which is a pretty broad measure of income. So the TCJA moved towards ending that bias, but then in 2022, the limit tightened to a smaller definition of adjusted taxable income called EBIT. So you dropped the DAW. You might hear some people say, save the DAW, if you've heard anyone talk about the interest limitation. This tightened it. It made it more binding. More companies hit the threshold now because it's lower. And it also makes this an international outlier because virtually no other country uses this tighter definition. So this is one way where the TCJA moved in the right direction by ending this kind of bias between types of financing, but did it in a weird way that made us an international outlier. And then another deduction, businesses also deduct state and local taxes paid, including income taxes, property taxes, excise taxes, sales taxes, any other type of tax. And that gives us an idea of the business tax base. The biggest problem with the business tax base being these depreciation deductions that overstate a business's income. And so with that, we can move to the rate. Prior to the TCJA, we had the highest corporate tax rate in the industrialized world. You can see that red line on the chart showing USA compared to the worldwide average that had steadily been falling. After the TCJA, when you include state and local average corporate tax rates, our combined tax rate is 25.8%. That places us right around the worldwide average. So we're by no means an outlier. We don't have an especially low corporate tax rate. We're just right around where the rest of the world is. To figure out your tax liability, you take that tax rate times the tax base we just talked about, and then we also have tax credits that can reduce a business's tax liability. These include the research and development tax credit, lots of green energy tax credits, the semiconductor investment tax credit, and the low-income housing tax credit, among others. And you may have thought we were done with taxes on corporate income, but there's actually a second layer of tax on corporate income in the US tax code. We've got that entity level tax we just talked about that applies to C corporations. And then when C corporations distribute their profits, whether that's through a dividend payment or whether a shareholder sells a share and earns capital gains, those face another layer of tax at the individual level. Some are taxed at ordinary tax rates, some are taxed at qualified tax rates or special lower tax rates. But to fully understand the picture of the tax burden on corporate profits, you have to look at both layers of tax that apply to corporate profits. And that results in the combined tax rate or the integrated tax rate on corporate income. So if you ever hear someone say, you know, there's a special rate for capital gains or the corporate tax rate is really low compared to the tax rates that non-corporate businesses face, you have to take both of these layers together to get the full picture, to be closer to apples with what's happening on the non-corporate side. Though I will say it's difficult to get apples to apples when you have two completely different systems for taxing businesses based on their legal structure. And with that, we can move to non-corporate taxes. So C corporation, taxed at the entity level and the shareholder level. Non-corporations, so these are your pass-through businesses like LLCs, sole proprietorships, et cetera, partnerships. They pass their income through to the individual owners, and then individual owners pay taxes on that income at their individual tax rates, the top of which is 37% under current law right now. You'll see on this chart that since the 80s, pass-through businesses have grown significantly while C corporations have shrunk. And that has happened even as the total number of businesses in the United States is growing. And so what you'll find is that most businesses in the United States are organized as pass-throughs, not as C corporations. And pass-throughs also account for a large share of all net income earned by businesses. Now, the sharp growth since the 80s is due in part to significant improvements in the relative tax treatment of pass-throughs compared to C corporations. So we had 2 tax reform acts in the 80s that cut the top individual rate from starting at 70% in 1980 to 28% by 1988. At the same time, the top corporate income tax rate came down from 46% to 34%. So there was a significant advantage to being a pass-through business compared to a C corporation. And then again, in 2018, we had changes to both types of business taxes. The TCJA, of course, brought the corporate rate down. It also reduced individual statutory tax rates. So the top tax rate came down from 39.6 to 37%. And the TCJA created the Section 199A pass-through deduction. That enables owners of pass-through businesses to deduct up to 20% of their qualifying business income against their taxable income. It also includes several limitations based on wages paid to workers, capital investment, and for specific types of businesses that are prevented from taking the deduction altogether. But effectively what it does is lower the top statutory tax rate on pass-through business income. It was imposed, or it was enacted to create what supporters of the provision would call parity between non-corporate businesses and corporate businesses. But what most research shows is that it, in fact, just maintained the advantage that pass-through business income has compared to C corporate income. And that's what you see in this most recent data from the IRS. The trend towards more businesses being organized as pass-throughs has not broken. It has continued through the data we have so far post-TCJA. And then the last point I want to make before we get to the kind of so what section is when we look at business tax revenue in the United States, we have to look at both of these sectors to get a full picture. You may sometimes hear, corporate revenue as a share of GDP in the United States is a lot lower than in other OECD countries. Well, that's because we have a relatively smaller C corporate pass-through sector and a relatively larger non-corporate sector. So if you want to get a picture of business tax revenue in the United States, you have to look at both types of businesses, revenues coming from both of them. And that's what this chart here does, and you kind of see the relative decline in corporate revenue as a share of GDP, the relative increase in pass-through revenue as a share of GDP. You also see a lot of fluctuations with business cycle downturns, so it's not a nice smooth line. It's a little bit volatile. It drops when the economy drops, and it grows when the economy grows. But overall, you see that we are close to the historical norm. We haven't seen a dramatic drop-off in business tax revenue as the size of the economy. And so now that we get the structure, the rates, how businesses of different legal organization pay their taxes, we can ask, what's the point? What effect does this have on the economy? What effect does this have on the incentives people face and the decisions that they make? So the corporate income tax affects investment incentives because it raises the cost of capital for businesses, which makes it more costly to invest in structures, machinery, equipment, productive technologies, so on and so forth. The tax burden created by the corporate tax or business taxes is a combination of the tax rate, the statutory tax rate, and the structural elements like depreciation deductions, net operating losses, interest deductions, all of those elements that we talked about. We can assess the burden that the corporate tax creates by a couple different measures of tax rates, and they each tell us a unique thing about how the business tax system affects incentives. So first, we can look at statutory tax rates. And you saw from that chart that the US is right about average with our combination of the 21% federal rate and the average of state and local tax rates. And the main thing we want to ask with statutory tax rates are what are the incentives for profit shifting? How does this affect the location of a firm's profits? If you have a really high statutory corporate tax rate, that creates an incentive for a business to recognize its profits in a jurisdiction with a much lower statutory tax rate. If you bring your tax rate in line with other jurisdictions, there's less of an incentive for profit shifting to occur. We also know that statutory tax rates are going to affect investment, but they also interact with the deductions that firms receive. And so to see a more comprehensive measure of the corporate tax burden on these investment decisions, we want to look at measures of effective tax rates, which incorporate both the statutory tax rate and these structural elements. So first we can look at what's called the marginal effective tax rate, and this takes like a hypothetical break-even new investment that a firm could make. So it's a forward-looking question and says, what's the tax burden on this investment that would just break even? In an ideal tax code, you would want that measure to be zero. That's saying that the corporate tax is not discouraging new break-even investments. It's providing a full 100% deduction for the cost of that investment. So it's not placing that burden, artificially increasing that cost. What you'll see here is that if the US maintains the business tax provisions, so 100% bonus depreciation, research and development expensing, the older interest limitation, not the one that switched to the tighter measure, our marginal effective tax rate is about 11.2%. So it's a little bit better than the OECD average, right? If we let those things all expire, that's what this current law measure looks at, it rises to 18.3%, so higher than the OECD average. And this is looking at what incentives do businesses face for new break-even investments. So you can see we still place a burden on that, even with the improvements with TCJA, and we'll place a much heavier burden on that if those cost recovery provisions go away. The average effective tax rate looks at kind of the same hypothetical situation, but an investment that does better than breaking even. It earns super normal returns. And this is looking at the location of investment. So if you have really high return assets, where are you going to place them? And again, what you see is that the US has a little bit better treatment than the OECD with TCJA policies. It would get a little bit worse than, well, yeah, it would get a little bit worse than the OECD average if you let those policies expire. Yeah.
So the marginal effective tax rate is driven by the cost recovery?
That's the big mover there, yeah.
And the average is driven, is that also driven?
Also driven, but it's just looking at different types of investments. So the first one is just a break even. The second one is better than break even.
So what drives the difference between the two rates?
Yeah, so you can, with a full deduction for investment, you would have 0 meter because you're deducting the full cost, but you could still have, you still place a tax burden on what's called supernormal returns. So like if you make a $100 investment, let's say like inflation plus the discount rate is 5%, you expect to get $105 from that next year. You wouldn't be taxed on that because it's just breaking even. If you make the $100 investment and you think it's going to do better than that, you get $110 next year. The $105 wouldn't be taxed because you deducted that $100 today, but the $5 would be taxed. So the average tax rate on that is a little bit higher because you have 0 tax on that first part, tax on the second supernormal return part.
And that's because with full expensing, a normal return investment will have 0 tax, right?
Yeah. So there would not be any, the second bar would be equal to the first bar here. And so there wouldn't be any disallowed deduction. There wouldn't be any additional tax on that. All right. So when you're thinking about who is burdened by a tax, Tyler hinted at this earlier. The legal incidence is on the C corporation. They cut the check or they make the electronic payment, but the burden can fall somewhere else. And the example I like to use for this is that I have a kindergartner and her teacher will assign her homework, and legally the burden of that homework is on my kindergartner. But she comes home and I have to help her with it. I have to make sure she writes her name, fills in all the lines on the worksheet, puts it in her backpack, gets it back to school. So the economic burden of that is split between me and my daughter. I bear some of it even though it's technically her assignment. We see the same thing happen with the corporate tax. Technically it's assigned to the legal entity of the C corporation. Economically, it may be shareholders who bear that burden in the form of lower returns to capital. It may be workers who bear that burden in the form of lower wages. And so If you look at different assumptions used in tax modeling, the Joint Committee on Taxation, for example, tends to use a split that 75% of the burden of the corporate tax falls on shareholders, 25% falls on labor, that'd be workers in the form of lower wages. At Tax Foundation in our model, we use in the long run a 50-50 split. We think it's closer to an even split between the two. In the economic literature, you'll see studies that find 70% up to 100% can fall on labor in different situations. The mechanism that this happens through is that when you have a corporate tax that discourages investment, that means businesses are purchasing fewer pieces of equipment, purchasing fewer machines, upgrading their technology less often, not building factories or expanding them. That capital stock is lower. And we know that capital and labor actually tend to be quite complementary to one another. So if you're a worker and you don't have better tools to work with, you don't have the latest and greatest technology to work with, your productivity is lower than it would be otherwise. And in the long run, what drives wage increases are increases in productivity. So when you're discouraging that capital investment, you're actually discouraging labor productivity and reducing wages from where they would be otherwise. So, yeah.
There's a chart that I see pop up all the time that shows wages and productivity levels. I'm sure you've seen this online. Can you speak to that at all?
Yeah, there's actually a really good article we could probably send around that debunks this, but it gets into using inappropriate measures of like what group of worker wages you're looking at versus whose productivity you're looking at, and then how you're adjusting those for inflation over time. And if you correct those two issues, you see productivity and wages are actually moving in tandem like you would expect them to. So yeah, a viral chart that's really annoying because like almost every like economic blogger has debunked it, but it keeps getting shared around. So what you have with a corporate tax, it seems, like this big distant thing, but it's actually affecting investment in your boss's district. It's affecting the wages that your constituents are earning because we have these long depreciation schedules. We have this corporate tax that's discouraging our capital stock, discouraging wages below where they otherwise would be. And we can also ask the question of, okay, whose wages are lower? Who is this really impacting? And we've got some really interesting research that shows that it tends to be workers at the margin. So younger workers, lower skilled workers, women who see the largest decreases in wages because of this channel. And Tyler mentioned this in his introductory remarks too. This isn't some kind of like out there theory or, like weird rambling. Even economists at the OECD and like really large research papers have said the line that the corporate income tax is the most harmful tax for growth. If you want to raise $1 of revenue, if you do it through the corporate income tax, you're going to have the worst economic impact than if you did it through other types of taxes. And it's particularly because of this effect on capital investment, which filters through to productivity and worker wages, that the corporate tax is so harmful. I think this is also important to think through, what's this mean for the distribution of the corporate tax? Because often you hear we can raise the corporate tax. That's mainly just going to affect the wealthy because it's going to hurt shareholders and hurt their returns. That portion of it is true to some extent. We know that wealthier, higher income individuals own more stock than the rest of us do. But the corporate tax also affects worker wages. And when you factor that in, it's much less progressive than you might think at first blush if you think just in the legal incidence world rather than in the economic incidence world. Yeah.
So how much of a distinction then is there between the entity level tax and like the capital gains tax in terms of, like if you shifted the corporate income tax to, you lowered that and you increased capital gains, is that?
It's a really good question, and it depends how open you think the U.S. economy is. So if you think the U.S. economy is really open to capital inflows, you place a tax on U.S. shareholders, that reduces U.S. saving. It may not necessarily reduce U.S. investment if foreign capital comes in and replaces that. At the Tax Foundation, we think the U.S. is very open to capital investment, and so we don't show a big hit to GDP. What we show a hit to from those taxes on savers is national income. because U.S. saving is falling. That investment is now owned by foreigners, so the returns to that investment goes to foreigners rather than to the American savers who would be doing it in the absence of that tax burden on saving. So it depends how open you think the U.S. economy is. If you think the U.S. economy is closed to capital investment from abroad, then a reduction in saving would result in a reduction in investment. So you would have a very similar impact as the entity level tax. All right, now to address a question that you might see in reports on a yearly basis, news headlines. XYZ Corporation paid $0 in federal taxes even though they had buku profits. What's going on with that, right? Two different things. It's comparing apples to oranges. Because in the United States, we have financial accounting standards that are determined by the Financial Accounting Standards Board. Those are generally accepted accounting principles that guide how corporations have to report their financial performance to their shareholders or to potential investors. And those rules allow quite a bit of leeway for corporations, and they also are designed to create a very different picture than what the goal of the tax system is. The idea here is to give a consistent picture of financial performance over time. So let's go back to that farmer or that construction company. Let's suppose they're a really large publicly traded corporation that engages in this financial statement work, and they make this huge investment in year one. If they reported that as an investment in year one on their financial statement, and no one went to read the fine print or the summary of what's going on here, you would see a really big drop-off in the reported income because there's this huge investment cost in 1 year, and then next year that investment cost would not be recognized because it was recognized last year, so it would look like profits go way up, and it could create this volatile picture. So the idea of these accounting rules is to say we're going to smooth that out. We're going to match that over time with when we think that investment is going to start earning revenue. And so it creates this nice smooth picture, which is a very different goal than what Congress has when it enacts tax laws. The goal of tax laws are to raise revenue and in some cases encourage, in some cases discourage different types of business activity. And like we just talked about earlier, if the tax code stretches deductions out over time and is then placing tax on that inflated income, you're actually placing tax on that investment activity. So there are very different goals for accounting rules versus defining taxable income. And that leads to gaps between what's reported on a financial statement, which may look really profitable, and what's reported on a corporation's tax return, which may not have a lot of taxable income. Those gaps are often driven by these timing-related provisions in the tax code, like depreciation deductions, like net operating losses. There can also be differences in tax credits. If Congress enacts a tax credit to encourage some type of activity, that can be reported differently on tax returns and have a different effect on tax liability than it does on the reported income and tax items on financial statements. So most of the time, what's going on is not some kind of crazy loophole. It's a law that was enacted on purpose. And it's also a difference that will smooth out over time. So if we're primarily talking about timing differences because of how a large investment is treated, if you take a 5-year or a 10-year snapshot, you're going to see those two measures of income come a lot closer to one another than if you just take the 1-year snapshot when that investment occurred. So it's not as bad or as shady as it might seem if you see these headlines. Typically, if you read down in those reports, what you'll see is, yeah, it's primarily bonus depreciation or other forms of accelerated depreciation or net operating losses driving these things, and those are in the tax code on purpose. And that gets us to some forward-looking provisions. So of course, we know that with the TCJA, it temporarily improved the tax treatment of investment by providing 100% bonus depreciation, but that's now phasing out by 20 percentage points per year until it goes away entirely. The TCJA actually worsened the treatment of research and development investment by requiring amortization over 5 or 15 years rather than providing that full and immediate deduction. We talked about the limitation it placed on net interest deductions. We talked about the pass-through, the Section 199A pass-through deduction, which will be expiring after the end of 2025. And then tomorrow, my colleague Alan Cole will be talking about international provisions, which are also scheduled to change in the upcoming years. Now, as Congress is debating what do we do over these expirations, plus the individual expirations you guys talked about yesterday, there's some other potential proposals for business taxes floating around, including lowering the corporate tax rate, perhaps lowering the corporate tax rate for specific industries. If we think about those principles of taxation, it may be pro-growth to lower the tax code in one area, or lower the tax rate in one area of the tax code and not another. You may get some additional economic activity from that, but it would violate some of these principles of neutrality and simplicity. There's been, one of the things left out of TCJA was how we treat structures investment. So we improved, like Tyler mentioned, short-lived investment. That's assets with 20-year useful lives or less. We worsened the treatment of R&D, and TCJA left structures investment untouched. Currently, structures are depreciated over either 27.5 or 39 years. So if I made that chart for a 39-year asset, it would look a lot worse than it does for the 10-year asset. So that's one area of the tax code really ripe for reform. There's also talk of limitations on deductions for state and local taxes paid by corporations, and then talk of eliminating green energy tax credits, both of those latter two being pay-fors for these other potential tax cut extensions. So in addition to thinking about those principles of taxation, when thinking about these options of what to do next, given the expirations, there's also a goal of promoting growth. And whether, Congress decides to look at fundamental tax reform and say, hey, we are gonna, unify the treatment of corporations and non-corporations and make them all pay taxes in the same way. We're gonna switch to some kind of like cash flow tax, or if we're gonna stay with the TCJA provisions and say, hey, we're gonna do bonus depreciation, we're gonna go back to R&D expensing, we're gonna go back to that more internationally accepted limitation on interest deductions. In both cases, if the goal is to promote economic growth, it requires permanence. You'll see here, we've done simulations with our model of what happens if you extend bonus depreciation for 5 years versus do it permanently. And what happens is under the 5-year extension, investment starts to pick up, but as soon as that goes away, investment falls down. You'll actually see the little bit of negative there in year 2030. The economy shrinks a little bit compared to what it would have been as businesses adjust to this, what becomes a tax hike on investment compared to what they were getting in the year before. If you make the provision permanent, though, that growth continues, and ultimately the economy is larger permanently than it would have been in the absence of that provision. And you can think about this from the perspective of a business owner, right? If I'm thinking about building a factory or adding another machine to my factory floor or buying a new tractor, I want to know that that makes sense in the long run. If I have access to 1 or 2 years of better tax treatment, but I'm planning to keep this investment around for the long run, 10 years, 15 years, I'm probably not going to change my long-term plans just because there's a little temporary change in tax policy. When it comes time to repair or replace that, the tax treatment becomes worse. It's not really viable for me to make that long-term expansion. And so that's why that stability and that permanence is required in order to get that long-run boost to investment and to output. What you might see with a temporary extension is that people take plans they were going to do otherwise and accelerate them so that they get the deduction while it's in effect, but they're not really changing their long-term behavior. And getting to a pro-growth package requires prioritizing the provisions that provide the most growth. One way to do this is to look at the bang for the buck of different provisions. We do this with our model at Tax Foundation, and we say, okay, what's the change in long-run GDP you're getting for the annual change in revenue? And you want a really good return on that tax cut that you're getting if the goal is to have a pro-growth tax package. what you see is that bonus depreciation of all the TCJA expirations that are on the table is the most pro-growth, followed very closely by R&D expensing. And if you think about why, that tax cut is entirely targeted at brand new investment. You only get to take advantage of that provision if you're making a new investment in the United States. No other provision is entirely targeted at new investment like that. Even a corporate rate cut targeted partially at new investment, but you're also lowering the tax rate paid on profits that are made from existing investment. So you're kind of splitting that incentive between a windfall for stuff that's already happened versus improving incentives for stuff that's happening going forward. Whereas with bonus, you only get it if you're making that new investment. So that's why you see that it's the most pro-growth. And again, that's if it's done permanently. If it's done temporarily, you won't expect any long-run growth to occur from that provision. To wrap up, the corporate tax rate of 21%, maintaining that rate keeps us right around the worldwide average. We're not an outlier anymore. Pre-TCJA, we were a major outlier, especially among the industrialized world. When you think about the rate, it matters because it's applying to the tax base. The most important thing to keep in mind with the tax base is that any policy that's short of a full deduction for investment is going to be discouraging capital investment because it means the tax is hitting that investment activity. The burden of the corporate tax doesn't just fall on the corporation, it's split between workers and shareholders. If you hear headlines about a corporation paid 0 taxes in one given year, that's probably just because there's a difference between accounting rules and tax rules. And tax rules, for the most part, exist for a good reason to improve the structure of the tax code. And finally, when we're looking forward at what do we do with all of these expirations, some of these broad provisions that improve the tax treatment of investment have already switched or are phasing out right now. And to get a pro-growth impact from continuing those, they need to be continued on a permanent basis so businesses have that certainty to plan out their investment. And with that, I'd be happy to take any questions.